With ongoing rate cuts and Enbridge's position as a leader in the Canadian utility sector, 2025 may just be their year to shine. Fasten your seatbelts, folks. This is going to be a good one. Enbridge is without a doubt one of Canada's most established utility giants, with a track record of steady dividends and strategic growth. This company has been an investing cornerstone for sure. I think it may very well be time to ask if this is the perfect opportunity to add Enbridge to your portfolio. Enbridge is a superstar in the energy and utility sector, specializing in the transportation of oil and gas, as well as renewable energy projects, with over 17,000 employees and a vast network of pipelines stretching, well, pretty much right across North America. They play a critical role in our overall energy infrastructure. What sets them apart is their focus on sustainability and diversification, making them not just a traditional utility company, but a forward-thinking leader in energy transition. In fact, they have three key advantages that make them a great play for sure. First, they've got their massive infrastructure. Their extensive pipeline network provides an economic moat, ensuring consistent revenue streams. In addition to that, they've got those steady dividends. They have a competitive dividend and a steady history of increasing it. In fact, they are a dividend aristocrat with more than 29 years of consecutive dividend increases. So that's not too shabby. Finally, their renewable energy investments, their strategic push into wind and solar projects positions them well for long-term growth as the world, of course, is transitioning towards cleaner energy. We, of course, also have to touch on that current rate-cutting environment that we're finding ourselves in and why that is the perfect scenario for a utility company. Overall, utilities do tend to thrive in low interest rate environments because they do tend to carry heavier debt loads to fund many of their large-scale projects. Rate cuts lower the cost of borrowing, allowing Enbridge to expand its operations or refinance existing debt more efficiently. This is a really good thing. Also, as rates drop, investors typically seek stable, high-yielding stocks like utilities, boosting demand for shares of companies like Enbridge. A sub to the channel is the best way to power some future content. Enbridge released their Q3 earnings covering up until September 30th, 2024. We will be using those earnings for this deep dive. As usual, I did get a chance to read through the report, and I wanted to share with you a few key highlights. They made a few strategic acquisitions in 2024 that include the purchase of the Public Service Company of North Carolina. That was a $2.7 billion price tag. Also, Q-Star Gas, which was a $4.1 billion price tag, and East Ohio Gas for $5.8 billion. These moves expand Enbridge's regulated gas distribution footprint and at the same time provides a platform for future growth. They also acquired 6 landfill gas to renewable natural gas facilities as part of their low carbon objectives. This does sound pretty darn good, but I have a feeling we will find the answers we are looking for in their fundamentals. So if there are numbers involved, we need to call on the prince of percentages, the friar of fractions, the one and only Mr. Math. We will start off with a little bit of their surface data. At the time of recording, their current value is coming in at $59.23. They've got a market cap of $129 billion, a pretty stable beta of 0.91, and their earnings per share 2.94. Looking to their price to earnings ratio, that came in at 20.15. Now, the average amongst their peers is a little bit lower at 17.90. A few of those peers include TC Energy with a PE ratio of 13.4, Pembina Pipelines with a PE ratio of 16.70, and Keyera with a 22.4 price to earnings ratio. Switching over to their price to book ratio, that comes in at 2.20. The average amongst those exact same peers, a little higher, 3.10. Looking at their return on equity, that comes in at 9.59%, and those return on assets, 3.13%. These numbers look okay, and they're pretty much what I would expect for a blue chip company. Okay, let's peel back another layer and take a look at their cash flow data. They have a revenue of 48.55 billion, and their earnings are coming in at 6.29 billion. Those earnings are projected to grow by 7.31% per year. Their current profit margin, that comes in at 12.9%. Looking at their free cash flow, that's coming in at 7 billion, and the operating cash flow is a little bit higher, 12.75 billion. They do have a good cash flow, which is not unexpected in a company with a fairly deep moat. So let's look at their fair value. So once again, that current value is sitting at $59.23 with use of a discounted cash flow model. We do get a predicted fair value of $122.49. That paints them as undervalued by 51.3%. Let's see if those analysts also agree. That 1-year target coming in at $61.10, so that's only an increase of 2.4%. I have a feeling that Enbridge can do better than that. Overall, their cash data is solid, though I do think, of course, that 1-year target may be a bit on the softer side for sure. Let's take a look at their returns data. Starting with their dividend, they have a yield of 6.365%. That's a quarterly dividend of 94.3 cents per share. The payout ratio on that, 114.0%. This is a little high, and I would like to see that number come down a wee bit for sure. Now, that dividend, we have said it has been increasing for more than 29 years in a row. So their 5-year average dividend increase, that does come in at 2.72%. We didn't say it was increasing by a lot. Let's take a look at those returns. Their 3-year return on investment, that's coming in at 21.27%. Factor in the dividends, we get a total return 43.25%. And if we look at their 3-year annualized, that's coming in at 12.73%. Okay, switching to their 1-year, that return on investment comes in at 24.59%. Add in the dividends, total return 32.35%. You will notice that their 3-year growth is skewed to the final year. And this actually makes quite a bit of sense, as that's when the rate cuts started. With the rate cuts expected to continue in 2025, this could be a good thing. Let's peel off one more layer and dive into that debt data. They have a total debt of 95.58 billion, and their total equity is sitting at 68.78 billion. So that means we got a debt to equity ratio of 139%. 5 years ago, they had a debt to equity ratio of 93.1%. So they have taken on more debt. And as we saw in the highlights, some of that extra debt went towards some of those 2024 acquisitions. Looking at their cash and cash equivalents, that does come in at 1.90 billion. Okay. On the short term, they have assets of 11.90 billion and their liabilities a little bit higher, 19.05 billion. I would sure love to see those reversed. Really, really would love to see those reversed. On the long term, their assets come in at 193.88 billion and their liabilities 117.95 billion. See, when they're reversed, it feels nicer. It feels nicer like these long-term numbers. Overall, their debt is pretty much in line with what you would expect for a large utility company. Nonetheless, that debt is not covered by their operating cash flow, nor is the servicing of it covered by their EBIT. You know, those earnings before interest and taxes. Now, in terms of share dilution, there has been some dilution at Enbridge. It adds up to a 2.5% increase in their outstanding shares over the last year. You know, I think we have enough data to make that final verdict. Enbridge is a very blue chip utility stock that, as I mentioned earlier, forms a cornerstone of the North American utility and energy transportation sector. This does afford them a level of stability. And as an investor, that does translate into lower risk. In addition to that, they have a very healthy dividend that does increase yearly as they hold on to that dividend aristocrat status. For long-term investors, this is one of those circle the wagon, foundation, hold forever stocks they will continue to grow in your portfolio for the years to come for sure. For shorter term investors, this is also a good option as the company continues to reap the benefits of rate cuts. Despite the modest growth the analysts predict in the next year, I think the potential is there to outperform those estimates. For the income-focused investor, this is not a bad dividend at all. However, I do know some of you are looking for something higher, like that one split core that only invests in Enbridge, ENS. Definitely a higher dividend, and they will benefit from the continued short-term growth from Enbridge as well. Regardless of your investing style, this is a good company, and at the very least, it is a stock worthy of your watch list. If you are interested in Enbridge, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on YieldMax ETFs. Thank you for watching, and I will see you in the next video.